Let's continue this conversation, actually, with Ed Yardeni. He's president at Yardeni Research, knows a thing or two about the bond market. Ed, on this question of just a higher premium, not based necessarily on inflation fears, but simply because we do have an awful lot of debt and it doesn't ever seem to stop. Right. Do you agree with kind of Mike's overall assertions?
Yeah, absolutely. Mike's got very, very good points that he's making. Look, I think the bond yield, the 10-year bond yield, is simply back to normal. 4 to 5% is a sign of a healthy economy. I think one of the main reasons that the bond yield is up here is because the economy can take it. And the economy can take it because there is a lot of borrowing going on, not just by the government, but by the hyperscalers. Interestingly, the spreads between corporate bonds and treasuries really hasn't widened at all. And so that's a sign that there isn't really a lot of stress in financing these things. I think all in all, there's, as Mike pointed out very accurately, only 4 basis points is what got everybody all stirred up last week. The bond vigilantes are back, but they're not the only players in the bond market. That's what Scott Bessent is trying to convey. And he does have an extensive toolkit, and so far it's working. It's going to muck up things for Kevin Warsh, because Kevin Warsh is looking for signals from the bond market, and here the Treasury is using its toolkit to send a different message.
Ed, you said so far it's working. You really think, isn't it a bit early to say whether this is actually working? It didn't seem like it did that much, had that much impact.
Well, I don't think that the expectations was. My expectation wasn't that this is going to lower rates. My expectation is that the Treasury made it clear they don't want to see 5% on the 10-year, and they are reminding us of what the Treasury did in 2023, not that long ago. The bond yield went from 4% to 5% in 3 months. August, September, October, November 1st, the yield went to 5%, and buyers came out of everywhere, and we saw the bond yield coming down because the Treasury announced that they were going to issue more bills, and that's basically what Bessent said last week. And now this week, they're just reminding us, or today, they're just reminding us that they have $1 trillion in cash that they could buy more bonds with.
Yeah, and when the Treasury did that the last time, Scott Bessent was very critical of it, and a lot of folks thought that Janet Yellen was manipulating, almost acting as a fiscal player, and sort of spending down this $1 trillion TGA, which had built up, and issuing more bonds, bills versus bonds. Now that's the same thing that's happening right now. What is, I guess, somewhat interesting to me, Ed, is that the thing that is perhaps most anxiety producing among equity investors is, are we overborrowing and overspending on AI? And that's the same exacerbating factor on yields at the moment, I think much more than the U.S. fiscal situation. So it has at least the potential to feed on itself. And maybe that's why there was, that much alarm being voiced last week.
Well, I think higher rates are not putting a damper on the issuance of corporate bonds to finance the hyperscalers' data centers. What is slowing down the data centers is political pushback, and also we've got the notion that there's a shortage of semiconductors, a shortage of electricity. So what are we really rooting for? Do we want them to spend all this money on data centers, or do we want them to slow it down? I think that it is slowing down, and that should help the bond market.
Given all those factors, then, do you think that the term premium will remain structurally high?
Well, I look at it simply as the TIPS yield plus the spread above the TIPS yield. And the TIPS yield has been running around 2.5%. The spread's been running around 2% or higher. We're looking at 4.5%. I mean, it doesn't really look like anything has really structurally changed in a major way when I look at the bond yield disaggregated like that.